Welcome to the Artisan Podcast, where we share insights from the world's leading investors and strategists. Today, you're in for a real treat. We have four of the brightest minds in real estate. In no particular order, there is Matt DeGraw from Bridge. Bridge is a fund leader in U.S. multi-res. In fact, it's the largest multi-residential operator in the U.S., which provides excellent insights as well as economies of scale. We also have Maxim Gagliardi from Dalfen. Dalfen is a leader in last mile industrial, which has been a huge beneficiary of the boom in e-commerce. We also have Romundt from Centurion. Centurion dominates the Toronto multi-residential market. It's widely viewed as one of the smartest operators in Canada, and it has a track record to back that up. Last but not least, we have Forman from Trez. Trez is a leader in the real estate debt space and one of the few players in lot financing, which we'll speak to later. What all three have in common are exemplary track records with returns consistently outperforming their peers. They also have top quality management and highly differentiated strategies providing sustainable competitive advantages. Enjoy. So let's get down to the question on everyone's minds. How are we going to make money in real estate in 2022? First, with you, Matt, go ahead.
Well, I'll speak, specifically to the multifamily market in the United States. The dynamics are still good. Cap rates have obviously compressed considerably, which makes some people nervous, but we are seeing very high demand, specifically in the Class B suburban space in which we play in. We've never seen as much demand as we're seeing right now. Rents continue to increase and at a faster rate than expenses. So at least in the multifamily market in the United States, it's a sound, safe investment at this point in time.
I know before the call we had talked about the market being a little bit frothy. What are some of the risks that keep you up at night?
Some of the risks that keep me up at night are we anticipating the right cap rate expansion? We're trying to be conservative on that front. But the other thing that keeps me up at night is, are we being too conservative on that front? The other thing that keeps me up at night is, rents are going up at a dramatic pace. We're starting to see more, more talk about, rent, instituting, certain percentage of rent increases in different markets, in different states. For example, California has tried to implement some rent increase regulations, as well as Milwaukee's trying. So, that definitely keeps me up at night. And working with the National Apartment Association and National Multifamily Housing Council to show that that's not the best way and not the best route for our renters and the individuals living in apartment homes across the country.
Matt, maybe after the call, you can speak with Greg a bit, because unfortunately in Canada, we've had 3 or 4 decades of rent controls. So, Greg, maybe first of all, speak to the question of how you're positioned for 2022, and then maybe speak a little bit about how you manage around, these rent controls and how you can still manage to really make exceptional returns in that environment.
So look, I'd start with saying I think 2022 is going to be an exceptionally strong year. We're seeing rent tightness pretty much everywhere starting to pick up as people, the borders start to reopen. Canada has very aggressive targets for immigration, about 450,000 people. So when you think about that, population growth like 1.5% per year. And, we're not building nearly enough product. House prices went up 20, 25, 30%, depending which market you're talking about. And incomes have not gone up that fast. But I think people are getting squeezed out, and we're certainly starting to see that that's starting to filter through in rents. I mean, rent controls are something you can you can manage to live with and make returns in. It all comes down to what you're buying. Canada actually has very good representation of rent-controlled and non-rent controlled markets. And what you find with rent-controlled markets is they can actually provide exceptionally good rates of return if you're buying, vintage product or older vintage product where you've got rents that can move up. But you also find that those markets tend to be extremely sticky when it comes to rent declines. So if you compare Alberta, which has no rent controls, to Ontario, which has rent controls, if there's any kind of slowdown and softness in the market, rents come down very, very quickly and they respond. Whereas in Ontario, they stick. So, I would make the comparison that apartments in Ontario are much more like bonds, not exactly, but similar to bonds. And Alberta is somewhat like equities. So you can learn to manage in those situations, but it comes down to having, paying the right price for a product that you're buying, and two, having the systems to manage costs, because cost containment is very important in a rent control environment, and learning, how to push and how to generate value in a rent controlled environment, and it's certainly possible.
So there you go, Matt. You've had some experts' advice in terms of rent control from somebody who's managed well through it for the past few decades. So Brett, you operate a lot in Texas and Florida and the Carolinas. Sounds like that's it's a mix between the Ontario market and the Alberta market. The Alberta market, because it's very uncontrolled, and the Toronto market, because as Greg said, it's like a bond, and you're actually on the debt side of the equation. And what we hear every day from clients is this thirst for safe yield. So maybe tell us a little bit about how you're positioned for 2022, that you can make some decent returns on the debt side, without taking too much risk. I mean, there's always this threat of reaching for yield, taking on too much risk because you have to, and then when the tide pulls out, we find out who's not wearing any clothes. So tell us about how you're positioned for 2022 on the debt side.
Well, we started with the geographies. I'm not sure I can necessarily compare to either Alberta or Toronto. But what I would say is in the United States, clearly the demographic growth, clearly the job and employment growth is in the Southeast and the Southwest. And that's where Trez has been positioned for 10 plus years. So we continue to have many boots on the ground, if you will, probably nearly 30, 35 employees on the ground in the United States in these markets that are showing the growth. And so we feel comfortable demographically, we're certainly in the right place. Then provide discipline for investment thesis, for risk management, risk control, and consistent growth, but also consistent returns. That's where we're positioned, and that's where we feel comfortable, always keeping the risk parameters first and foremost, and returns second, growth behind that. But we have exhibited good discipline and been able to keep our consistent returns for our investors in a safe environment. I think 2022 will be more of the same. There will be frothiness. There will be continued competition. But I think a competitive advantage we have is having people on the ground that really understand the market, have deep and broad relationships, and will execute on the right transactions. Remember, debt, you should have, in theory, some safeguards because you're not in the equity position. And in theory, if you're backing good equity, good developer sponsors, there should be a margin for error. So we're very grateful for 2020.
Okay, Thanks a lot, Brett. And how about you, Max? You're in a very different market. You're in industrial. So how are you positioned for 2022? What are you seeing in terms of the market outlook?
Yeah, so we're still very excited. I mean, it's been obviously an amazing run over the last couple of years. There's been significant tailwinds and really a change in how the economy is structured with the shift to e-commerce, right? So obviously, industrial has been a big beneficiary of that, but specifically last mile industrial, which is we view as different from industrial in general, right? So we're talking close to the end user, close to the important transportation nodes, deep labor pools, and we've seen double-digit rent growth over the last 3 years, and we're still seeing the same thing. So I think, obviously there's a lot of new entrants. People are coming in, they're trying to get in on that action, and I think it's important to stay focused, right? It's a difficult market to learn into, but we try to be really focused and continue to target the markets we've targeted. I think I'd echo Brett's comments about the Southeast, the Southwest. Those have been huge markets for us, it's just tough to find yield these days. So we definitely see it in our space.
Absolutely. And so let's start off with you this time, Max. Look, not on this panel, but in general, there's thousands of funds that are in the industrial space. What makes yours different? What leads to your sustainable competitive advantage?
Sure. I think if we look at most of the people we compete with, they're either much larger funds that have to go through operators like us, or much smaller funds. So we don't see a lot of fully vertically integrated platform. So we have 9 offices throughout the country. We have sourcing people in these 9 offices, looking for deals in those locations, trying to source deals off market, especially when the market gets hot. We still believe we can overperform over our target returns just based on the rent growth we're seeing and the cap rate compression. But you got to source deals off market, and we source about 80% of them off market. The reason we focus on this last mile niche versus in general industrial in general is that there's really important secular trends that are driving that, right? Onshoring, nearshoring. With COVID, we've seen a lot of companies trying to increase their inventory levels, right? Because there's been disruptions, and they're trying to make sure they can provide and keep the supply chain sustainable. So e-commerce is obviously another one and those have all been pushing for locations that are close to the end user. Because that last mile is the most expensive mile, right? So it's the only way to make your supply chain viable.
Yeah, I think that's a good point. And how about similar question to you, Brett, especially in terms of this proprietary deal flow. That seems to be very critical on the private side. So maybe you can speak to the proprietary deal flow. Particularly in terms of lot financing, and then more generally on the debt side, there's also a large number of funds. Why should investors choose yours?
Well, that's a good question. And I think that in a market that is increasingly competitive, both on the developer side and on the debt and equity side, I think first and foremost you have to look at a track record and consistency. You may not deliver the very highest. That's not what we're aiming for. We're aiming for the most consistent, and that's why Trez has been able to be consistent and has grown with its investor base. Likewise, our borrowers may not be the least costly option. However, we're going to be the most consistent option and perhaps the easiest to execute on. We understand the developer's needs and tailor fit a model solution for their needs. We are not a mid-place lender. We are very tailored and structured in our approach. And for that reason, we continue to grow. In fact, we have a lot of existing relationships with whom we have long-standing relationships and repeat borrowers. Going back to where you said proprietary, I'm not sure you would call it proprietary, but we do have a deep expertise in lot development. That should be distinguished from land because we don't do land financing. We do lot development financing where the end customer is ultimately the home builder. And for that reason, we feel very bullish on our segment of the business. Our knowledge is tremendous. Both our deep and, I said, broad relationships within that industry. And of course, as I believe it was Max or Matt that said, we've got tailwind. Right now, the housing market in the United States, in the Southeast, in the Southwest, is extraordinary. And we tend to focus on the entry level or the move up level, certainly the price attainable market. It's been extraordinary. So we feel very fortunate to have been both geographically positioned and positioned for the residential lot and residential sector as a whole.
Yeah, I think that's well put. Correct me if I'm wrong, but I believe in kind of your key geographies, there's really only one or two other people providing lot financing for any degree. So as opposed to a lot of other deals in the debt world where you're really competing with thousands, you're competing with two or three in your core positions in Texas or Florida. Okay, well, on to you, Matt. Why should investors pick your fund? I mean, beyond, really for many, many, many years, top quartile returns. I think we're at like 18, 19% average a year. Beyond that, what would be the value proposition to say, here's why we'll be able to keep doing this in the future, even if the environment is a little tougher?
Yeah, no, it's a good question. Similar response. You look at our track record and look at the dynamics of why we were able to outperform our competitors, and look at the now. I think the dynamics of how we're set up are the same. We haven't, our senior team has been together for over a decade. I've been at Bridge for 17 years. So really our approach has not changed. Our approach is very similar to how it's been on the three funds that were rated, number one by Preqin. Our approach is very similar, but at the same time, we're sharpening the pencil every day with our business intelligence analytics and in how we underwrite and how we execute. The other reason is similar to Max's reason. We're vertically integrated. That helps us be very efficient across the country. We have, vice presidents and regional managers stationed across the country. We know our markets very well. When we go in to invest in those markets, our underwrite is sound before we do the due diligence, and that's helpful. 9 times out of 10, if we miss, it's because of the operations. And being vertically integrated helps us adjust on the fly and adjust quickly and be able to execute at the ground level, which is where really the alpha is made, is at the site level.
How about you, Greg? I mean, historically, Centurion in the Canadian market has really been in a league of its own. What would be the value proposition for, let's say a new investor, somebody, that doesn't have that experience? Why should they be comfortable that will continue in the future?
Well, look, I think you have to always be forward-looking, and one of the things that we've been able to perform, not only because I think we've been able to put systems and processes around our business to acquire smartly, not overpay, and those are important disciplines. But I can't deny the fact that the space that we're in has had really strong fundamentals and a lot of positive tailwinds. And I think if we look forward, those tailwinds continue to exist, if not, are accelerating. It's been my view that, apartments, unlike in the United States, we've really stopped developing as a country in the 70s. And it takes so long to produce new product here. 4 to 7 years is kind of the development cycle here, where it's a fraction of that south of the border. So supply responds much more slowly to demand. And we've got record immigration and intentions to continue immigration. We've got exceptionally low vacancy rates, and in our stabilized portfolio, we run 99+% vacancy, or occupancy. And really that 1%, 1%, it tends to be just unit turnover, right? But we rent them as much as possible back to back. We've got this core view that in Canada we're going to build as many apartments in the next decade as have been built in the last 2 generations, or 50, 60 years. So we think there's tremendous opportunity. We think that the rents are extremely tight. Rents are very cheap, actually, compared to the price of housing. So we talked about the price to rent ratio. So I think when you add up, positive immigration, the inability of supply to respond, structural impediments to that supply responding, and inflation picking up, and all these are all really strong tailwinds, which I think carry us through for another decade.
Yeah, and just while we're on that topic, we do have a lot of listeners in the Metro Toronto area. I know it's not your core investment, but it has a pretty big impact on multi-res, and it's always of interest to really any Torontonian. Any thoughts on the Toronto housing market? I mean, valuations are more expensive than they were in the U.S. In 2005 when the bubble burst. Any thoughts on how this is going to play out? Is it possible that it just deflates softly? Is it a disaster waiting to happen, or is it not really a risk?
Well, first I would distinguish between what happens with houses and condo prices and what happens with apartments, right?
Absolutely.
So this is a distinction not everyone kind of understands, but became very clear, I think, to more people in the last year. But more in the last year, because many people just think that there's this one thing called the real estate market, and there's not, right? Apartments perform very different than retail or hotel did in the last year, and finally, I think people understand this. I look at Toronto prices and I think that they're absolutely crazy. And I look at the same thing with financial asset prices, stocks, etc., are crazy. However, this is a reflection of near unlimited money printing, artificially suppressed interest rates, and rising inflation. Real estate bubbles tend not to deflate slowly. They deflate in a very painful way. Now, what's different in this case, and this could go either way, and it depends on how policymakers respond. But my belief is that one of the reasons why real estate prices are appreciating so quickly, almost everywhere, is I believe that people aren't dumb. They see that money is being given away. You can borrow 10-year money at 2%, and people understand, okay, if inflation's 5 and I borrow money at 2 and I can invest in something that goes up with inflation, people are responding rationally to that. I think gutturally they're understanding that inflation is picking up. So, and I don't believe that the governments can allow interest rates to go up because they've spent so much money and they're basically already bankrupt. So, there is every prospect that what we get is runaway rallies in nominal terms, but not necessarily in real terms when it comes to house prices, because people's purchasing power in the last year has not increased 25%. It just has not. Just the money supply has gone up by that amount. So, it doesn't have to be a hard landing in nominal terms, but we just could see continued runaway price growth. But that's just inflation by another means.
I think that you've really struck a nerve there, and you've spoken to a lot of themes that actually come up at Northland at our weekly investor meeting. We probably discuss them too much. And that's this idea that all asset prices are expensive due to money printing. And so today, if we speak to that, we see that stocks are falling, of the view that bond yields are rising. So maybe I'll turn to you, Matt, in what has to be considered one of the major risks, the risk of rising interest rates, right? Because the decrease in cap rates for the relatively steady yield that you see in real estate has not been linear to falling interest rates. It's definitely been faster than the decline in interest rates. What happens if interest rates go back up? And how are you positioned, or how will you protect the portfolio?
Yeah, it's a good question. I guess it depends on, why the interest rates rise. If it's because the economy's doing well, that could be positive for rental increases across the country. But in any case, the rates and the cap rates don't typically move in tandem. There's still a good spread between cap rates and treasuries, suggesting, relative value. So, I think that with the rent increases that we're seeing, that's probably our hedge. We are not underwriting the rent increases that we're experiencing. We're being very conservative in that realm. I mean, you can go to any state that we operate in, you're seeing anywhere from 20 to 30% rent increases on trade outs if someone moves out to when they're moving in. But we're not underwriting that. We're being conservative and anticipating normal rent growth in our underwrites.
And I was just wondering, go ahead.
We also hedge our interest rate risk as well. Sorry. We do fixed rate loans or caps on floating. So that's another way we're hedging.
Obviously, rising interest rates have a bit of a different impact on debt compared to equity. So, Brett, how do you think that rising interest rates will affect Trez? And how are you positioned to offset those risks?
Well, recognizing that our loans are made using floating rate interest rates. So our rates go up and typically have a floor as to how low they can go. So our loans themselves are certainly, I guess the word hedge, but are safe for interest rates. The counter would be, if the value of the real estate were to decrease, but similar to what the other members are saying, I don't really see a huge drop in value coming. Of course, sometimes you don't see it, sometimes fears of the unknown. However, it's tangible, and there's a lot of money chasing both tangible and intangible assets, but certainly tangible is something that feels good. International money is flowing into the United States looking for real estate and for return, yield. And so real estate is always something that can offer both tangible, you own something, and it's going to get a return of sorts. So we at Trez, although we will not pursue rising rental growth in anticipation of something becoming more valuable, when we do a construction loan, we're counting today's rent so that we're not getting ahead of our skis, if you will. But I do think we will be, well positioned should there be a softening because of the way we underwrite and the discipline that we have.
Yeah, very interesting. And how about you, Max? I mean, I guess with multi-res, you tend to get at least annual rent increases. So if interest rates go up because of inflation, you can roll over quickly. Is the industrial market different than that because leases are longer or more flexible or the current dynamics? What do you think the impact is of rising interest rates on your market, and how do you mitigate against it?
Sure. So, I think, realistically, when you invest in real estate, you have to respect interest rates just like the sailor respects the sea, right? So, I think the key there is leverage, right? There is a risk. Interest rates can go up. Just like many of our peers, we usually have floating rate debt, but we're fully hedged, right? So we have caps or swaps or something to mitigate interest rate risk to the full exposure of our floating rate exposure. But then again, you want to make sure you can capture that upside, right? And so we don't underwrite that rent growth, but there is obviously, we're seeing 10-20% is not uncommon for us. But to your point, yeah, I mean, listen, there's we typically have predetermined contractual bumps in our leases, and the truth is, most of the leases are going to be 3 to 5 years, right? But a lot of clients we're seeing now are requesting longer term leases, which is great for stability. But typically, that's something we prefer not to do, unless you're an Amazon of the world or a Target. We'll do 10 years, but otherwise we keep it to 3 to 5 years. But that's why you have a diversified portfolio, so that not all your tenants are rolling at the same time. And sometimes that's good because you never know what happens. If something happens, you still have some of that higher rent that can continue for a couple of years. So eventually, over the full term of an investment, we'll see through all that stuff. And given that the value is mostly or in great part derived by the exit, right? Typically in our world, it's 70-30. So as long as you get there, and even if you don't get there, you're usually able to get the buyer to recognize that he's buying into below market rents. So you're able to create value that way as well.
Interesting. So, I mean, so far, we've really spoken about maybe shorter term cyclical influence. Let's lengthen the time horizon a bit and talk about some of the potential structural changes because of the pandemic. My thought is there are certain things that people believe are permanent that will turn out not to be permanent because of what's called the recency bias. Whenever something's happened most recently, people put much more weight to that and simply extrapolate. On the other hand, there are certain things that are in place now that have created permanent change. They say it takes 1,000 hours to create a habit. Well, unfortunately, we've had the pandemic for a little more than 1,000 hours. So a few things that have been going on. Some might be permanent, some might not. This, idea, on the office side, I think in Canada, the occupancy is about 25%. US, it's probably similar. It's, of course, going to go up from here. But my thought is there's about 10 or 15% permanent loss because of people working from home like me. My job's in Toronto. I'm never living there. And there's a lot of people that are like that. And these are kind of structural changes. Then you have people moving to the suburbs. You have cottage country that have gone crazy. I mean, when is the last time that Sudbury was one of Canada's hottest markets? Like, people in Vancouver are saying, wow, price increases in Sudbury are pretty high. So what are your thoughts? Maybe we'll start with you, Matt, on impact of the pandemic. What are maybe a couple things that people think are true right now that will turn out not to be 3 to 5 years? That provides good opportunities. And on the other hand, some things that we've started to see that they ain't going away.
Yeah, it's in the multifamily space, it's I don't think a lot has changed, to be quite honest with you. The one theory I would dispel is there's not a tidal wave of evictions about to happen. You see that in the media, that there's this tidal wave of evictions waiting to happen. One thing that we learned was that our space is very safe. Instead of collecting 98, 99% of the rent pre-pandemic, we collected 95%. And there's a percentage of those individuals that are working the system and not communicating with us, but the majority of our renters are that lost their jobs or could not pay their rent are working with us to get caught up, and they're not ghosting us. So you won't see the tidal wave of evictions happen. Our goal is to keep everyone in their home, to work with them as much as we can. The structural changes is I think our company and most of our competitors moved to paperless systems quicker than we thought we would. requiring rent to be paid online versus with a check or money order, signing your lease, renewing your lease online versus coming into the office. It just pushed our industry forward a little bit. So those are some of the structural changes. And man, how do we keep managing our apartment communities if this happens again or something else? So all of our, key employees can be mobile. Managers have laptops, assistant managers have laptops, the leasing agents have, handheld devices so that they can still work from home if they need to, whereas before that couldn't happen. But, you still have maintenance guys on the ground that have to fix stuff inside the apartment. So there's a lot of things in the apartment world that just won't change.
How about you, Max? How do you think the pandemic structurally impacts, the last mile industrial space or logistics or warehousing, the areas that you play? Yeah,
It was a very interesting year, right? When I think it was 2020 when the pandemic first hit. For about a month, we were kind of wondering what would happen if people would stop paying rents or whatever. And, very quickly, within, I think, 2 months, we went back to near 100% collection. I think that's when people realized that, if you look at the overall supply chain, labor, transport, that's over 70% of the cost. Real estate is just 3 to 6%. And and if you can't sell your goods in store, you need that warehouse so that you can ship those goods. It's the only channel you have. And now, going forward, stores are opening up again, and people are still going to want, the store experience for certain products. But, look at e-commerce growth. Most forecasts are showing that by 2030, you're expected to be about 2.5 times the level we are today, right? Those are trends that are not stopping, that are going to continue. And obviously, last mile industrial is a big beneficiary of that. So I think we're excited on that front, and I think there's a lot more to come on that front.
Very interesting. And how about you, Greg? What are we seeing either in Canada in general or the Toronto market, kind of core downtown, versus the suburbs versus smaller municipalities? What do you think are the structural changes because of pandemic, and what things are people extrapolating that are just going to be plain wrong?
So it's a good question. I think flexible work or work from home is going to be permanent. I'll give you some data points. In our own workforce, we're continually surveying our staff about their views on return to work, and at one point we were, call it 75% wanted to return to the office, not 100%, but some kind of flexible work arrangement, 50-50. Our current surveys are suggesting over 75% of our staff now do not want to return to the workplace. They want to stay permanently at home. That's our own data. I think it's work from home is continuing to drive more people to the suburbs. So in our own workforce, again, we've surveyed this. About a third of our head office staff have moved to the suburbs from Toronto. 0 have moved in. So, now we've been very forthright with our employees about telling them, look, work from home is going to be a permanent fixture in this company. We're probably not coming back to the office for a long time. We do want to get back together when we can. But people have taken that opportunity to maybe move from a, apartment they were renting in Scarborough to home ownership in the suburbs. Or, renting something that's much bigger. So I think that this is a permanent thing, One of the other things is I believe that COVID shattered the inertia of life. What do I mean by that? It means, you can just go through day to day and do the same thing. And COVID forced everyone to think, do I really want to do this anymore? And so we're starting to see this show up, when restaurants are opening and they can't find anyone to work there. People don't want to do these crappy jobs for crap pay, and they don't want to be precarious, like on the edges of the financial system, and they can get thrown to the wind. So there's a lot of discussion. This is just because the free money governments are giving away, and that's part of it. But I think people have changed in their view that, well, if I'm going to be precariat, I might as well be an entrepreneur or be an influencer or online or do something else, that at least they get some of the financial upside of that precariousness in life. I think one of the things that, certainly the politicians and the central banks are trying to emphasize is that this inflation is transitory. And I've been trying to argue for the better part of a year that none of this is transitory. And this is structural. And one of the things that will make this structural, aside from that you can't get these employees to come back into the workforce because they don't want to, but even more importantly is we're going through a process of deglobalization where, we're re-onshoring these supply chains. So we spent 30 plus years in globalization, which allowed these deflationary forces to work its way into lower inflationary numbers. But now we've got our supply chains tied up in China. And aside from COVID, I think there's broad recognition that we do not want our supply chains tied to a communist country who's not really very friendly. And this has very significant implications to not only our supply chains long term, but the reversal of those disinflationary forces that will play out over the next decade or even 20 years. So this could be very painful.
Very, very well put, Greg, and very thought-provoking. I mean, perhaps we need for you to come into our weekly meeting at Northland, because we're debating those topics. Sometimes it can get pretty intense. Luckily I'm remote, so there can't be any physical violence. But if that wasn't the case, I think we should thank goodness that some of us do work remotely. Now, Matt, do you have a different experience or a similar view in terms of inflation? Because, when you talk about boots on the ground, Bridge is the largest, multi-res operator in the United States. Like, they're seeing all kinds of things, not just real estate costs, but all the costs that go into property management. What are your thoughts in terms of the inflation, Matt? Transitory or permanent? And how does that impact how you manage? Or what are the implications for the asset class or the fund, depending on your view?
Yeah, it's a big impact. Right now, one of the biggest struggles is finding maintenance individuals to do the work at the site. It's a constant battle. You just have to really focus on culture. People have to love coming to work and enjoy who they work for, but also at the same time, you have to stay in front of the market and be competitive with your pay, right? So, it's kind of a rock and a hard place. You need to make sure you're paying well, but you also need to make sure that you're doing the right thing for your LPs, because that payroll cost is a big part of the the return on investment, the NOI of that asset. So it's not easy right now, and the impact that it has is what we've found is in the apartment world, the quicker you can turn an apartment home, so when someone moves out to when you can turn it to be rent ready again for that next person, is critical to occupancy. So that's the struggle we have right now is making sure we're paying our maintenance individuals competitive salaries, competitive hourly wages, creating an environment where they're happy to come to work, and an environment where they're willing to tell their friends, you got to come work at Bridge. So so far so good. That unfortunately a strong market can mask bad management. So we're trying to make sure we're dotting our I's, crossing our T's with our culture and with our employees, and making sure we're paying them a competitive salary.
Very interesting. Very interesting. So let's change tack a bit. As they say, real estate. Sorry, go ahead.
Joe.
Sure.
Joe, can I just echo what Matt said? I think right now, this point, people are looking at quality of life, whether it be working from home or having worked at home and enjoyed family and taken advantage of things that people did not take advantage of because of COVID. That I think today and may very well contribute to inflation whether it's direct pay and
Very interesting. But let's change tack a bit. As they say in real estate, it's location, location, location. So, Max, what are the hottest markets? If we weren't going to invest in your fund, where should we be putting money? Right now, what geographies look attractive?
Yeah, it's interesting because when you see the market going up, very often you see the spread between A, B, and C, product types and locations. I mean, these spreads are tightening, right? So it used to be that you're buying an Inland Empire, it's going to be much tighter cap rates than the Midwest, for example. But as values are going up, everything is tightening. So for us, we're really trying to focus on we're going up the quality spectrum, right? So we're making sure, we're buying the best product right now that we've ever bought, over history, right? We're buying more recent, better construction, better functionality, higher clear heights, because we want to make sure if we're going to pay higher dollars, we got to buy the best stuff possible, right? That's the best hedge over, anything bad happening. And so, but that's also true for markets, right? So we're going a little bit heavier on the coast. We love the Southeast. We love the Southwest. Markets like Seattle has always been robust. California, Georgia, Florida, Carolinas. We love the Carolinas. Texas, Phoenix, Vegas has been a great market. We've been trying to aggregate portfolios. A lot of what we do is really buying one by one, right? If you buy $1 billion portfolio in our space, you're going to pay the highest dollars possible, right? And so a big way how we create value is because we've got boots on the ground, we've got a fully vertically integrated team. We're able to buy these assets one off, 10 to 30 million bucks, one chuck at a time, and create a portfolio, and then you can turn around and sell into that very institutional market. So it's all about trying to stay focused on value, building portfolios, and then monetizing them.
Makes sense. And how about you, Greg? How do you see things in terms of Canada, or you're also actually involved in some other things beyond multi-res? You do have some exposure in the U.S. Which market do you think is the most attractive right now? Where are you diversifying into?
Well, I mean, we like markets across the country.
Okay.
Some more than others. We very much want to, our strategy is a suburban exurban market surrounding major metropolitan areas. So, for example, we don't buy inside Vancouver, but we buy the suburbs around Vancouver because we think that rents on a relative scale are very cheap. The cost of product, in dollars per square foot, is also much cheaper. You get more space, and I think that people were already moving to the suburbs and exurbs due to affordability prior to COVID, but now they're moving there for lifestyle. When you can't go to the theater, to the extent that you did in Vancouver, or you went to the symphony, or you did all those cultural things, and then you didn't for a year and a half. Yes, some people missed it, but other people said, I'd rather have twice as much space.
Right.
And pay, half the rent. Than live in a tiny little box apartment at the top of the 30th floor. And by the way, it takes me 45 minutes to get down and 45 minutes to get back up.
Right.
And man, is that a pain in the butt when I got to walk the dog, right? 3 times a day. So, I think that so that's one of the things that's attracting us to those types of markets.
Right.
I'm an energy bull, so because I'm pro inflation view. So if we didn't have the government we did, I'd be all over Alberta.
Okay.
But because of politics, it's very hard to be an Alberta bull today.
Okay.
I still think that they will do fine. but I would be gobbling property there hand over fist because I think it's, price per square foot,
Right.
or quite reasonable. The yields are pretty decent, but it's hard to execute when you've got political headwinds that really have not gotten any better for that province.
Okay.
I certainly like also Quebec a lot.
Okay.
For the same reasons. Price per square foot in Montreal and surrounding areas is a fraction of what it is in Ontario or in Toronto. So I'm able to buy brand new concrete product in Montreal way less, like in dollars per square foot, than I can for 50-year-old product in the suburbs in Toronto. So you have to just look at values, and all these places you can find value, you can find growth. It's just weighing price and yield.
Okay. No, it certainly makes sense. And how about you, Brett? You've had a position in Texas and Florida for quite some time. You're moving into some other southeastern states. What would be your favorite markets right now? Yeah.
I think, overall, we have been bullish on the Southeast and Texas, Southwest, and that's continuing. But I think where we also find is being opportunistic, similar to what the, equity sponsors are saying, that they're looking for, perhaps better price per pound or yield. We can lend to sponsors that are finding that better relative value. So potentially, rather than financing something in, urban Atlanta, Georgia, or Miami, Florida, you might pick a market like Greenville, South Carolina, or Huntsville, Alabama, that has very good demographics. It may not go up as fast, but then therefore its foundation is very solid, and it doesn't go down nearly as much as something else could. So we find good value in those tertiary markets, albeit
definitely makes sense. Matt, I know that part of what you have focused on are kind of fast-growing markets, and then also areas where you can create value. Some of that seems to overlap with the areas that Brett is involved in. So, like I say, you have huge exposure across the United States and a lot of local presence. So I'm really quite keen to hear, what out of all of those markets, what would be some of your favorites right now?
Well, during the pandemic, my favorite markets were Dallas and Phoenix because those were markets where we collected close to 100% of the rent. I don't want to get political on the reasons why, but those were my favorite markets. But very, very similar. I guess it all depends on what your criteria is for the better market. I don't love California because of the rent control they're trying to institute yet. We've seen the best rent growth in Sacramento and in the Inland Empire just outside of LA. So those have been great markets for us, even though, collecting the rent has been more difficult there. But definitely Phoenix, definitely Dallas. We've had a lot of success in Tucson, Arizona recently. They've had a tech boom there, and the job market is excellent. I mentioned Dallas. We love Atlanta, Tampa, Orlando, and the Carolinas. So, and recently got into Virginia, which has been a fantastic market for us. So there are a lot of good markets across the country. I agree with the tertiary comment too. We have an asset in Greensboro, North Carolina. We'd love to buy more assets there, but can't seem to find a deal that we can make pencil. People are bullish on that market as well. So there are a lot of fantastic markets across the country, but those are some of my favorites.
That's great. So we have a few minutes left. So let's do one final question. Brett, if let's say you were given $5 million a day and you could just put it in one investment, what would it be?
In just one investment, $5 million, it would certainly be residential. It would certainly be southeast, southwest, our themes. It would probably be in either lot development, which we have a tremendous business throughout Texas, the fastest growing state in the country, and perhaps something that will be focused on not as much for sale residential, but that single family for rent component of the market is tremendous, and it kind of brings the best of both worlds because it's a rental product which gives people optionality and affordability.
And same question to you, Greg. Let's clarify. This is 5 million Canadian.
Okay. So I'll give you two answers on
Sure.
this. First, if I'm trying to allocate that capital inside of our own fund group, I would be doing, probably outside the suburbs of Vancouver. So
Okay.
I'd be looking for something. And I love Kelowna. Kelowna rents have been rocking. A lot of people are moving there for all the things we've talked about. Or, I love Victoria. Any of those areas, I'd be looking for a new purpose-built apartments. If it was outside of our group, I'd say bullion.
Okay. So you're clearly a worrier about inflation. How about you, Max? 5 million. You can choose whether it's Canadian or U.S.
Okay, might need a little bit more than 5 million, but I think would build a brand new Class A facility in South Florida. I think it's an established market, exceptional rent growth, exceptional population growth. It is extremely supply constrained. You've got the ocean, you've got the Glades, and then you've got this little piece of land. So West Palm Beach, Miami, all these markets, we'll build something Class A, 40 clear, top-notch facility there.
Well, hopefully not for a very long-term investment, because with global warming, your investment might be, no pun intended, underwater. How about you, Matt? Where would you put 5 million US?
I'd put it in Bridge Multifamily Fund 5.
That's the easy one, man.
I would diversify in the multifamily space, and our fund is diversified across different states, different submarkets. We don't have we have regulations on how much we're going to do in, for example, Atlanta versus how much we're going to do in Phoenix, and not have too big of a contingency in one versus the other. So I'd diversify in the multifamily, value add, B plus class space with $5 million.
Thank you so much. That was an amazingly interesting roundtable. I've been looking at real estate for years, and I learned a lot today. So thank you very, very much for your time. Just to kind of summarize for our listeners, this is a group of managers with exemplary track records. They've consistently outperformed their peers. And part of that is what you can see today is really top drawer management, with strategies that have sustainable competitive advantages. So if you need any follow-up information, don't hesitate to email anyone at Northland. I believe my name was on the invite, and we look forward to seeing you next time. Thank you, and have a wonderful day.
Thank you.
Thanks a lot.